folks. Perfect. Okay, I want to switch over to our wonderful PowerPoint presentation. Here we go. All right, my name is Joseph Smith. I'm one of the wise guys in ties. My business partner, as you can see pictured below, Mr. Ray Fleming, he is also here, but he's handling the technical aspects, making sure that I look and sound fabulous to all of you, and answering any questions that come in on the YouTube channel. I'll handle any questions that, of course, come in on the webinar. But listen, folks, hey, this is our time every Tuesday at lunch, where we call this Think Outside the Bank, because there's a lot of people looking for funding for their business, but they find when you go to the bank, they're not always lending. And in these uncertain times, you would think that they, with all these regulations that are being lifted and all these emergencies that have been declared, that supposedly there's supposed to be more liquidity. But as you see with the stock market, and I mean, the banks are no different. They're still going to be very tight when it comes to lending. So we need to learn to think outside the bank, learn to look at other different secondary types of lending, but also consider the lending that is available through the bank. So again, my name's Joseph Smith. I'm one of the co-founders of Wise Guys in Ties. We exist to help people simply achieve your God-given purpose. We want you to start a business. We want you to build and grow and achieve your American dream and the success that you were put here to have. So if you want to contact us, our contact information is on the screen, our phone number, our email, and you can always go to our website. But let's dive into today. We're talking why most people fail to get funding. And it's this type of information that's critical to you getting success and building and growing and money and funding for your business. So let's talk about business financing, because this can be a challenge, right? Because if you're a startup company, you don't have the time in business. And most lenders are looking for 3 to 5 years in business. So if you're already a startup company, you're thinking, I'm behind the 8 ball. See, lenders are already, without an emergency going on, they're already cautious. Their whole goal is to mitigate risk. They want to make sure that they get paid back. I mean, if you put yourself in the bank's shoes, if you were lending money to somebody, wouldn't you want to make sure you got paid back? Of course. So here, with business lending, there are several options. And we're going to talk about a lot. We're going to be very brief, and I got to go fast because we only have a little bit of time. But these include traditional lenders. We're talking about banks. So you're looking at loans, sometimes lines of credit, right? There are online lenders. There's a lot. We'll talk briefly about some sources there. Microlenders. And you're like, micro, what are we talking about? Micro is just like it sounds, small. Sometimes all you need is like $300, $500, $1,000, $25,000. That's all you need. If you just could get a small little micro loan, then you could do what it is that your business needs. Sometimes you don't need those huge, big SBA loans of $100 or $250,000. So sometimes micro lending is an option. Of course, there's the SBA, the Small Business Administration, which sets the guidelines that other lenders follow, and then they can, of course, if they follow that, then they get government backing for these loans. So most business owners, what do? They start looking, I think they start looking for money when they need it, and you really should start looking for money before you need it. So if you're looking at the way the economy, what's happening in the economy, I mean, there's a lot of volatility right now. I mean, things are low. I mean, people are talking recession. I don't know if it's really going to get that bad. People are worried about the housing market, what's going to happen. Folks, I say if you don't know what's going to happen, stay calm. But you should always be prepared, because it could get worse, but it could get better. So we don't know where we're at. We're at a crossroads right now. But it's good to make sure that if there is going to be a downturn in the market, that you have as much liquidity that you have possible. So have a certain amount in mind. I mean, it's usually good with your business to know what it is that you need. Are you looking to expand, hire an employee? What is it that you need to do? Consolidate some debt to lower your cost. Understand this certain amount, because it's easier to achieve a goal if we know what that goal is. So when people apply typically to a bank, they don't qualify. And if you're a new business, it's because you don't have enough, time on the water. Basically, you don't have enough skin in the game if you don't have any collateral, credit, or cash flow. So most people are stuck into thinking that banks are the only place that you go for financing, which is why we have this webinar to show you there are a host of other options open to you. So we're talking about people that are educated, they've have business finance, MBAs, but they just, the education, the way the system works is it's put you into a box called the bank. It's a box shaped building, right? And so all of your options and all the way that you look at financing is through the bank. They are one of many options, and so let's dive in. Briefly, I want to talk to you. There is a short history of business financing, and you go to no greater source of wisdom than Wikipedia to find out that it goes all the way back to ancient Mesopotamia in the 5th century, and that there's actually a bank in Siena, Italy, that's been operating since 1472. Banca Monte dei Paschi di Siena. I probably just totally butchered that, but look, the whole reason we're letting you know, because banking and credit, they have been around for a long time, right? The term credit was used in the 1520s, and it's been extended. It goes back over 5,000 years. Credit has been around before there were coins or cash, right? Even George Washington kept a bar tab. Okay, so we know that that this is something that we need to learn. Right, it's been around for, so these principles and the different types of lending that are out there, it's not brand new, it's not fandangled. The reason why we don't know this is because we haven't been educated. The education we have received has pushed us into one solution that fits all, but it doesn't fit all. So what's better than a bank loan? Well, we talked about online lenders, microlenders, the SBA, but what about unsecured business financing? This is what I call that credit card stacking method. If you've worked with me before, I talk about how we have with the loan officers that we work with, our loan officer team, they have a way of doing a credit card stacking method where they can apply for a lot of credit cards or a lot of lines of credit for you all at the same time. Because if you do it on your own and you apply for one, you get a line of credit, then you apply for the next one, you get a little bit less. And by the time you get to the third one, you may or may not get approved. You start getting denials. But with the unsecured bank business financing, you're able to apply to 5, 6, maybe even as much as 8 different credit issuers all at the same time and get approved. This leads to people getting sometimes as much as $150 or $1,000 in corporate credit cards, because to each of the individual credit issuers, the way it's applied for, they see your credit application and they don't see that you've applied to anybody else. Very powerful. Crowdfunding, we'll go into that a little bit later, but an excellent way with, especially with social media and the way that we interact with other people. If you have a great idea, bringing your idea to market and getting the funding that you need. Crowdfunding has been used to fund so many different people's, like a band. You want to start a band and you want to start going on tour, right? People have crowdfunded to fund their band. I mean, there's all kinds of application. Revenue-based lending. So if you're in a business and you are making money, but you just you haven't been in business very long, and you don't have really any collateral, revenue-based lending, and I've been on the last couple of Tuesdays, we've been talking about all different types of revenue-based lending. So there's a lot of money that's out there for merchants. If you're bringing in money, you can borrow based off of the amount of money. You can collateralize the actual revenue of your company. It's pretty powerful. So we're also going to talk briefly today about angel investors, venture capitalists, people that are going to invest in your company. Because one thing you don't want to do is you don't want to feel like, oh, I need to go ask and borrow money from people, and oh man, you know how horrible it is. Like, hey, mom or Uncle Joe, or you talk to your brother or your sister. Nobody wants to go and ask somebody if they'll borrow money. No. if you're a business owner, you're a business owner. And if you need money, you're giving somebody an opportunity to invest in your company and get what's called an ROI, a return on their investment. Or you're giving somebody who's maybe a lender to your company a chance to make some interest off of the money that they lend. So it's a business transaction. So angel investors, venture capitalists, wonderful opportunities. We're going to talk about factoring. You might not even know what that is. We'll go into that today. Business credit cards, inventory financing, business credit. So what can a business owner do? Well, in many cases, right, you have credit cards, maybe you use personal credit cards, and they can work. But what really comes down to is you need money, and you need to figure out what you need that money for. For example, if you need $10,000 for office supplies and $10,000 for furniture and $5,000 for computers, so you chunk it down, you don't necessarily need to get that full $25,000 in one lump loan. We could find $10,000 for office supplies at maybe with a store card, and then we find another card or issuer for the furniture, and we get another. So it could be 3 different micro loans potentially. So there's a lot of different ways to look at it. A lot of times we just total everything up and we're like, oh man, I need 25, I need 30, I need 50, I need $100,000. But maybe we could break it up, and maybe you don't need all of it right away. Sometimes people think they need all this money right off the bat, and what you really need to get started, you might think, oh, I need 150,000. But really all you need to get started is maybe 50,000, and then the rest can come later. So we got to look at, how much do you need and what do you need it for? That's really important. You might need to improvise and get funding from a lot of different sources, but hey, you're in the right place because our loan officers can refer you up to 27 different lending programs, and they work with hundreds of different lenders to find you the money that you need. So strategies for getting business financing. Well, it's good to look at your business strengths, because you might feel like, well, I haven't been in business that long, but maybe you have some cash flow, maybe you have some business credit. If you've been working with us, you've been building business credit, maybe you have something. But also consider that maybe your resources, you the owner, could be your personal credit. Or maybe if you're not the resource, maybe there's somebody that's willing to be like an angel investor and be a personal guarantor for your business, right? If you have a great idea, you're ready to come to market, there's so many different things that people want to invest in. And if you can find the right venture capitalist, right, and you can pitch it, your business or your business opportunity or your product, right? Think of Shark Tank, right? If you've got a killer idea, a killer product, but you just need a little boost to get going, right? Then we can help you find that kind of money. So let's talk about online lenders. So often the chance of getting financing depends on a combination of things. So what is, and this is going to be for pretty much all these different secondary lenders, but what is your annual gross revenue or your monthly gross revenue? How long have you been in business? What is your personal credit score? And do you have the ability to give a personal guarantee? I mean, what is that credit score looking like? We're looking for at least a 680, if not better. I mean, ideally, it would be great to be over 700 with your credit score, but it's not just a credit score, because we want to see that the utilization is under 30%. And that's not total utilization across all your lines of credit. That's on each individual account. It needs to be under 30%. Sometimes we've had people who could get access to $100,000, $120,000 in lines of credit if they first paid down one of their lines of credit by, sometimes $6,000. And it's like, oh man, so then people feel like they're stuck. I can't do that. It's like, wait a minute, you can't find $6,000 to pay down a line of credit to get $120,000. I mean, you just have to work out a deal with somebody, a gap fund loan, something. Right, it's all of these things are out there for folks. All right, so also keep in mind that collateral will be necessary. Once you start going for amounts, borrowing loan amounts over $150,000, there's always going to be some kind of collateral involved, and we'll talk a little bit more about that. And then forms and applications have to be filled out, and then the fees on all of these things vary. There's origination fees, success-based fees, there's all kinds of fees. So it's good to make sure that, especially when you're working with our loan officer team, they're going to break it all down for you. So you know what your interest rates are, you know your total loan amounts, you understand the terms, you understand the fees, you understand everything before you even apply. So that's what's important, that you make informed decisions. Microlending, it's just like it sounds, small amount of money. So there's we're putting something on the board there for you. You can go look right there to microenterpriseworks.org. A microloan, right? It's not a lot of money, anywhere from 500 to 35,000. But it's just what it is. Like some people, they just need a little bit of money to get going. If they just had 2,000, if they just had 20,000, right, they could get going. But so microloans, they're going to be these short. It's going to be a short-term loan, higher payments, sometimes higher interest rates. You gotta understand how this all work, right? Let's talk about the far end of the spectrum, the SBA, right? Small Business Administration. Well, they're going to have a lot of stringent requirements, but not everybody can qualify for these. But if you can, well, you get through all the paperwork. I mean, then the world is your oyster. I mean, if you can get a small business loan or you can get a small business line of credit, say you're into you're a commercial builder, you can get a lot of things funded. I mean, if you're into research and development, there's SBA grants where you just get money that you don't even have to pay back. It just depends on the kind of business that you're in. But they have various cap line loan programs, SBA Express. Now the SBA doesn't provide, I think I said this before, they don't provide the loans, they set the guidelines. Their lending partners actually make the loans, and if they follow the SBA guidelines, then it becomes government backed. Oh, and there it is. I was talking to you about research grants. If your company engages in research and development, that is something that the government wants to see. So we talked about the unsecured business financing. Sometimes we abbreviate it UBF, or credit card stacking, right? So these are going to report to the credit reporting agencies, not your personal credit, but the business credit. So that's great, because when you use, when you first get these lines of credit, when they first, to qualify, they are going to run your personal credit report. So there will be inquiries, but after that, everything gets reported on the business side. So what do you need? You're going to have proof of cash flow, or collateral if you're collateralizing it. But most of the time they want to see if you're working at a job. Can you provide W-2s? Can you provide bank statements? Can you provide tax returns that verify that you have income coming in, steady income, right? So time in business is not a factor here. So they're not really looking to see if you've been in business for 5 years. This is really based off of, you're really collateralizing yourself personally, or if somebody else is doing it, it's like co-signing on a loan for somebody else, right? You're co-signing on a loan for your business. All that matters is your personal credit. So you're going to need quality credit with no derogatory reporting, no foreclosures, bankruptcies, right? So, and there's a time frame to that, like within a certain so many years back, 7 years typically. So with a 650, you could only get personal credit. So if you have a 650, somebody might give you a $500 personal credit card or a $1,000 credit card. But to personally guarantee business credit cards, you're going to need to have a score of 680 or better, right, to give a personal guarantee. With the 650, you can have like up to 10 inquiries on your credit report and still get a personal credit card. But if you're going to personally guarantee a card, you have to have no more than 4 inquiries within the last 6 months. So, and what's great is when you apply for business credit, these credit cards come at 0% introductory rates for, it says here on your screen, 6 to 18 months. I've seen them as far out as 24 months. But then after that, it's going to jump up to somewhere between 5 to 21%. and that's an annual percentage rate. But keep in mind that it's going to be based off of your financials. So the better your financials, the lower the rate will be, and the higher your financials, then the higher the rate will be. But still, it's a great opportunity. I love unsecured business financing. You only pay on what you owe, so it's not like a loan. You don't, so if you get $25,000 in corporate lines of credit, you don't have to use all 25, right? If you only need 15 right now for marketing that you're doing, then you just use that, and then you're only going to pay interest on the amount that you're using. So it's just like, it's a corporate credit cards, just like regular credit cards, except for you get about 5 times more than what you could on the personal side. And it comes in, like I said, anywhere from 5 to 8 different credit cards. Low introductory rates, 0%, as we talked about. So talking about fees, what's that going to cost? Well, there's all different kinds of people that do the credit card stacking, the unsecured business financing. You're going to see the fees range anywhere from 9% up to as much as 12%. But take heart. Let not your heart be troubled. We like to work with a lot of different lenders. So we usually, because of the volume that we're always pushing through, we tend to find the lenders that are closer to the 9% range. So if you just want to do some easy math, let's say you're going to qualify for $150,000 in corporate lines of credit. Well, then you could imagine that your fees are going to be somewhere around $15,000, right? Probably a little bit less, but that's just a good rule of thumb if you're trying to figure out how much it's all going to cost. But I want you to know that, someone's like, well, that's outrageous. That's crazy. I'm not going to do that. Doesn't matter what, if you go for a loan or a line of credit, doesn't matter what program it is, there's always going to be fees, origination fees, setup fees, your broker fees, loan officer fee. There's fees for everything. So even on SBA loans, there's fees. So you just have to run your numbers. If the numbers make sense, you do the deal. Would you spend $15,000 to get access to $150,000 in lines of credit, or I guess more technically $135,000 worth of lines of credit? Is that worth it? Would you spend $15,000 to get 135? Sounds like it's I wouldn't say no right off the bat. It depends on the terms and the fees, and the structure of it, but yeah, I would. But that's only a question that you can answer for yourself. So this program, like most others, roll in their fees, so you don't pay up. Well, that's nice. So it's not like, say, give us $15,000 right now, right? It's okay, here's your $150,000, and now we've invoiced you for $15,000. So you don't have to pay for it before you get it, and that's great because, hey, I want it to be a success-based fee. You give me $150,000, and then I'll reward you for that success by paying your fee, right? Then it's easier, right, to pay on a 0% interest credit card, the $15,000. Sure. All right, let's talk about let's shift gears. Let's talk about crowdfunding. Try like a service Kickstarter. You got to always read the fine print, but you got to read the fine print on any loan, because as you start raising funds, they're going to take their cut, whatever site you go through. If you're using Kickstarter, anywhere from 4 to 10%, right? You may have to give all of the funding back if you don't make your goal by the campaign's end. So you might be right there on the cusp and you don't make it. Well, then it all goes back, right? Indigo has flexible funding options, but it costs more. So you always got to look at the fine print. Straightforward businesses might not do so well. So if you're just an average, hey, I'm a restaurant, or whatever your straightforward business means, you're not novel. And crowdfunding really goes towards the novel. So if you have something that is creative, it's new, no one's ever seen this before, or it's a twist on something, or you're combining 2 different things that haven't been done before, that excites people and it generates more in crowdfunding. But if your business is ho-hum, then crowdfunding, at least at large dollar amounts, is typically not seen. So keep that in mind. But it just depends. Like if you've got a great invention, we work with a lot of inventors. They've got this great product. If you can really sell the potential and all the different applications of your new product, and you've got your patent, filed, and you got all this stuff, and you're ready to bring in your crowdfunding so that you can start getting your supply chain together and put the whole product together. I mean, this is crowdfunding is a great opportunity for that. Products which aren't quite on the shelves yet or artistic endeavors do well, which is what I was just saying. So securities-based financing. What about stocks, leveraging stocks? Well, I'm talking about this when the stock market's really down. But again, what's great is when you use security-based lending like this, look, you can borrow as much as 90% of the value of your stocks. And when you put them up, you're using the stocks as collateral, but you still get to keep the stock. It's still your stock. That's what's great about it. So you're borrowing against the value of the stock. You can use that money. You have to make your payments back, right? But you can get rates as low as 1.6%. This stuff funds fast too. I mean, if you are going to put up, this is a collateral-based type of loan. So the value is in the collateral. If you don't pay, then that stock that you're holding, it's like your lender forecloses and then they get the stock. But as long as you make your payments, pay everything back, great. You paid everything back and you still keep the stock. So you get all of the still, if it continues to earn and grow. And I'm not one to play the stock market, but if the stock market's down, right, I think that a great principle, at least I see, I'm a real estate investor. So when housing prices are low, I like to buy, right? And then when they go up, then that's when I want to sell. So if stocks are low, it could be time to buy. I don't know. I'm not in the stock market, but sounds like a sound theory, right? But this is a good thing where you don't have to worry about a lot of credit checks or anything, because remember, it's a collateral-based loan. We talked about angel investors, and we talked about venture capital. So what is that? Well, angel investors typically invest in the early stages of a startup company, which is great. So in exchange for 20 to maybe 25% return on their investment, they'll give a certain amount of money to fuel the startup of this business. But you're going to be taking 20 to 25% of your profit and giving it back in payment. So angels tend to invest less, and they don't really want control. Angel investors, I mean, sometimes they can be parents, relatives, close friends, right? But now let's switch to the venture capitalists. Now think Shark Tank really on this, right? If you've seen that show, they'll give money to help build new startups, but they have to have a good feeling that this is really going to grow fast, and it's all going to be based off of the high risk potential. But these venture capitalists, they want to invest in a fast growth. They have this plan to get out within probably about 3 to 5 years, and but they have a lot of money, so they could invest hundreds of thousands, millions of dollars, whatever it takes, as long as the business model is sound. They're also going to take some control of the company, because they need to make sure that everything's going to go the way that they want it to. So they're not looking. So when people have to give up control of their company, it's not a forever deal. It's usually they just they have a certain amount that they're going to invest. They're looking for a certain rate of return, and they want to do this very fast, because they want to always remain liquid, because venture capitalists make money by lending it out and then making it grow real fast and then getting more and then lending more out. So that's their business model. In the meantime, in the short term, yeah, you give up some control of your company and your profit, but you have somebody who's very skilled and knowledgeable about growing businesses fast at the helm of your business, running the ship. It's exciting when you're working with a venture capitalist. Okay, factoring. Some of you are like, well, what's that all about? So if your company gets a percentage of outstanding invoices, well, okay, the way it is they lend you money based off percentage of your outstanding invoices fronted by the company. So a factoring company then goes directly after any company which owes you money. So if you have an invoice or an outstanding invoice for services rendered, and you work and you have a large client database, and you got a lot of these invoices out, well, what you do is instead of you waiting to try to collect all that money and these people pay you back, you sell these invoices to the factoring company, and they, again, they're not going to give you dollar for dollar, but maybe they'll sell it to you 70, 80 cents on the dollar. So now you've got cash immediately right up front, and then they'll go be the collections arm. They'll go get their money. So it works really well for companies, especially if you have a large client database and you've got a lot of IOUs or a lot of invoices out there. I mean, and again, that's a great way to grow your business. You want to get a lot of clientele. Say, yeah, hey, we finance, we fund people. You start working on with these firms, you can get a lot. You can grow your database, your client database, very quickly. Then, if you find yourself, well, we're really strapped for cash because we've got so many invoices out there that are unpaid. Well, let's find you a factoring company that'll pay you for a percentage of that. You know, you don't have to sell all invoices forever. Just take a current look at your invoices, sell off the ones you need, get the money that you need, and then keep doing business. And then if you're able to still run things and grow, perfect. But if you ever find that you're getting stuck, then you can always sell off a portion of your outstanding invoices. Wonderful business opportunity. A lot of business owners that have invoices don't even realize that this is a possibility. Even works really well when the government, right, local, state, federal government, if you have a type of business where you cater to the government and they don't pay you every month, maybe they pay you quarterly, or your bills are due now at the beginning of the month, but they're not going to pay you to the end of the month. This works really well for a lot of those folks. All right, business credit cards. You're like, wait a minute, didn't we just talk about that? All right, business credit cards are credit cards that your business applies for, right? They're just like personal credit cards. I mean, if you applied with your social security number, then your personal credit score is at stake. But when you apply for business credit cards and you have a business credit score, then you don't need to use your personal guarantee. You can actually get credit based off of the strength of your own business's business credit profile. So if your business credit is reporting, and that, see, the whole point of this slide is to really show you the difference between personal and business credit, because a lot of people leverage their personal credit for their business, and you're putting your own utilization, credit score, everything that you do on the line. And the more that your business needs money, it begins to really hamper yourself on the on your personal credit. You don't want your utilization to go over 30%. Right, you got to keep it under, ideally 25. So this is where a lot of people start their business, and then they've over leveraged their personal credit, and then they see their credit score going down. But at that point, it's too late. It's like the ship sinking. What do? I can't get any more money. So we want you to build business credit. All right, business credit. If your business has its own credit, it can apply for its own credit cards, and it doesn't need you to give the personal guarantee. Inventory financing. Well, let's talk about that. You might have the kind of business that you've got a lot of inventory. You just use it as collateral. If you have $500,000 in inventory more, I mean, this works great if you're a auto dealership. I mean, think about all the cars you have on your lot, right? If you anytime you're in your inventory, it's anything in your supply chain at your warehouses. We have a lot of different logistics company, and they have a lot of different things. So it's not hard to actually have $500,000 of inventory. because I mean, you need to turn that and you need to sell it, and you got to make your money back. But sometimes that's hard when the economy, something happens and things slow down. So you can get up to 50% of your inventory's value, and your interest rates will be anywhere from 5 to 50%. It's very short. You get this money within like 3 weeks. Minimum loan 150,000. You can get you could go down as low as 300,000 is what they're saying, but again, you got to look at what can be what can and can't be valued here. So this is something that if you think you're close or you might qualify for this, you're going to work with our loan officers, and they're really going to go over all the different type of requirements that go into inventory financing. Business credit, we've talked about this. It's business that you credit that you apply for in your business name. So you need a legitimate company. Okay, so if you can't be a sole proprietor, can't be just a DBA doing business as, right? We want to see a real business registered with Secretary of State, your own EIN number, professional website, professional email, professional phone numbers. We want your local number to be registered with 411, but you should also have a toll-free number as well as a fax number. You want to have a professional business address. Ideally, a lot of people, they start with a home address or a PO box. You want to stay away from the PO boxes because that really is a red flag of a scam, because people that are trying to scam the lenders out there would use a PO box because it's easy. Home address, it can work. You can build business credit with a home address. There's just several lenders that are uncomfortable lending to home-based businesses. They just don't. You're going to be the next Steve Jobs, right? They don't think you're going to be the next Mark Zuckerberg. But there are plenty of businesses that have started as a home-based business and done very well. So there are lenders out there that will lend, but you start cutting yourself off from a lot of lenders if you use a home address. So having a business office, an actual, like you see here, I'm in an actual office, that's the best scenario to be in. But I mean, if you don't have the ability to be paying, $1,500 to $2,500 a month in rent, I get it, right? So that's why a virtual office is a good option for you, right? So when you build business credit, you've got to have starter. It's done. You're building a foundation, right? So we start with net 30 accounts, right? Once we get 5 to 8 of those reporting on your business credit bureau, on your business credit report, and that's very tough because only 3% of them actually report. So you got to find the right net 30 accounts that will report. You've got to use them for 3 months before they will report. So most of them that do report, they'll only report after you've been using them every month for at least 3 months, right? So then you use them, and now you can start building on store credit. We're talking like Amazon, Lowe's, right? The Home Depot, where we start getting cards that work at those individual stores. Then we want to build those up, and we want to get to the point where we have 10 revolving store line accounts reporting. Then we move on to fleet credit. Now, here's what's great is getting fuel cards, and not just little fuel cards either. We're talking like $6,000, $7,000, $10,000 fuel cards. Now, don't go crazy, right? Don't bite off more than you can chew. But the goal is to build up to 14 credit lines, all positively, within a 6-month period of time. If you follow these steps here, you'll easily have $50,000 or more in lines of credit available to your business just through the building process. And now you can move on to those high limit credits where you can now take your business and apply for up to as much as $150,000 in lines of credit. So good business credit will help you get the loans that you need in the future as well, because the more you use this credit, the better your business credit rating. When you go to apply for a loan, and you can both put your business credit and your personal credit online, as well as if you're looking at collateral or cash flow, it just enhances and helps you get those better terms for loans. So to recap, Most people fail at getting funding. Why? Because they think banks are the only place to get funding. Viable options include online lenders, unsecured business financing, business credit cards, inventory financing, as well as building your business credit. Personal credit scores and time in business may determine some of your choices, right? Some people are going to require a personal guarantee until you've been in business for 3 to 5 years. Okay, so you've got to work around that. Maybe you need to start building your business credit, because you can build your business credit without using the personal guarantee. So you don't have to put up your own money, even though a lot of times it feels like, well, I've got to use my own money, my own savings account. If you learn how to leverage your finances, it's easy to do. Business credit helps because you can build the foundation of your business by borrowing into the future, right? So you're going to borrow from your future profits and get credit now. And so there'd be debt, and you're carrying debt and you're paying on it, but you're using the business credit, that liquidity now, because it takes money to make money, so that you can fund the business in the future that you want to have. And if you can build and grow it now, it'll be, I mean, like anything, you have to build it, you have to grow it, you have to feed it, give it the money to grow, but it doesn't have to be your money. That's the thing that's important. So how do you do this? How does somebody take advantage of these opportunities? Well, what we do, if you're working with us here, the Wise Guys Ties, we're going to put you through a financial blueprint qualifier, and you're going to see it's very simple. It takes like 10 minutes for us to go through this with a client. We just get all of the basic information, how to contact you, why do you need the money, how much do you need, right? We're going to get information on your business, what's the income of the business. We're going to look at any type of assets that you might have that we could collateralize. We want to get an idea of what your personal credit scores are, and then we're going to need you to sign up, if you don't already have some type of credit monitoring service, sign up for a free one. And then we pass this. This is a straight referral to our loan officer department, our team, and they'll get back with you within 24 hours and basically say, well, here's a snapshot of where you're at today. This is what we show that you could qualify for. And then they usually give you some suggestions like, well, if you came down on your utilization on your credit card here, we think we can actually do this. If you decided to collateralize some of your assets, we could go this direction. So the more information that you give the loan officers to work with, the more options for lending that they have for you. All right. So how do you take advantage of this? Go to our website, wiseguysinties.com. It's very simple. It's right there on your screen. This is what our website looks like. And you just, you can download, grab yourself a free guide that covers those 4 different stages that I talked about: vendor credit, store credit, fleet credit, and cash credit, so that you can know how the steps on how to build your business credit. But on this page, just scroll down and you can set up a free 30-minute consult with us. Let us see what your business goals are and how we can help you reach those goals. And if you want to get started and find some direct funding for your business, let's go through the process. It takes about 10 minutes. Let's put your information in and get you over to our loan officer team and start finding some money within maybe as little as 4 to 6 weeks. And then you can then have the fuel that you need to fund your dreams. I want to thank you for your time on here. I did have a question come through real quick. I know we're out of time, but let's see here. We say, will they lend to a trust? Yeah, a trust can build business credit. That is one legitimate way. There are a couple of things that you have to do with your trust, but schedule a free consultation with us. I don't have enough time, of course, to cover everything, but let's talk about it. So contact us. There's our phone number. You see 888-5BizCred. It's also 888-524-9273. Or there you see is our email address, bizcredit@wiseguysinties.com, or go to the website. It's very easy to learn a lot of information, get some free book downloads that you can use, and set up a consultation all on our website. I want to thank you so much for thinking outside the bank. I'm Joseph Smith, And also I'm speaking on behalf of Ray Fleming. Want to thank you. Have yourself a great week. And be sure to check out our website, future events. Tonight we have a credit banking mastermind. And on Thursday we have another Think Outside the Bank, focusing on another aspect of building your business credit. Have a good day, folks, a great week, good night, and God bless.